In this video, we'll examine the four major order types when trading in the stock market. We'll look at the market orders, limit orders, stop orders, and stop limit orders. Shaun G Academy. Nurture your investment and educational appetite. Order types. Stock market order types determine when you want to order and at what price. We look at the four major order types in this video: the market orders, limit orders, stop orders, and stop limit orders. We'll examine these four order types and when best to use them. First, the market order. With the market order, we're saying we want to buy a stock and we want to buy it now. Whatever the current price of the stock is, that's the price you want to buy at. Or if you're selling the stock, that's the price you want to sell at. So for example, if you see a stock and the current price of the stock is $10 and you're buying at $10, $10 is the market price. So it makes it a market order. So if you buy, it's a market buy order, and if you sell, it's a market sell order. So a market order is buying or selling a stock at its current price. The next order type is a limit order. With a limit order, you're saying, I want to buy this stock or sell this stock, but there's a limit to how much I'll pay for it to buy it, or there's a limit to how much I will accept when selling it. Let's say, for example, a stock is currently trading at $10, but you don't want to buy it for $10. You said the most I'll pay for this stock is $6. So that's your limit. My limit price is $6 to buy this stock. So you set your limit price to $6, and when the price falls to $6 or below, the stock will be purchased. And that would be a buy limit order. You set your limit price, how much you're willing to pay for the stock when buying, the maximum price you're willing to buy the stock for. On the other hand, if you own the stock and want to sell the stock but you have a limit to how much you would accept for the stock, then you will set a limit price, the minimum price of which you will accept when selling the stock. So for example, say the current price of the stock is $6, but you wouldn't accept anything less than $14 for the stock. Then you will set your limit price to sell at $14. Not until that price gets to $14, then the stock would sell. So that would be a sell limit order with a limit price of $14. So with limit orders, when buying, you'll set the limit price, which is the maximum price you're willing to pay to buy a stock. And when selling a stock, the limit price would be the minimum price you're willing to accept when selling a stock. Next order type is a stop order. And when using a stop order to buy, you want to ensure that the price is trending up before you make a purchase. So if you're not sure which way a stock is going to trend, you can use a buy stop order to ensure the stock is trending upwards before you make a purchase. For example, let's say a stock is currently trading at $8, but to be sure that the stock is trending up, you want to wait until it gets to $10 before you make a purchase. So you set your buy stop price at $10. So when the stock price reaches $10, your buy stop order is executed. Now when selling, a sell stop order can be used to prevent a loss if the stock price drops, and that is why it is referred to as a stop loss order when selling. So there are two scenarios in which you can use a sell stop loss. Firstly, for example, if you bought a stock at $10 and just in case the stock starts trending down and you want to get out at $9, then you will set your stop loss price to $9. So if the stock falls to $9 or below, the stock will be sold and prevent further losses. Another scenario in which a stop loss can be used is if you bought a stock at $10 and the stock starts to rise and you're gaining profits and you want to lock in those profits just in case the stock turns and starts to trend downward. Say you want to lock in your profits at $14, then you will set your sell stop price at $14. So if the stock trend at or below $14, it will trigger a sell and you will lock in your profits at $14. And the last order type is a stop limit order. As you can tell from the name, it's a combination of the stop order and a limit order. With a buy stop limit order, we're waiting for the price to trend up before we purchase the stock, but we only want to purchase the stock if the price falls below a certain price. For example, if we want to wait for a stock to trend up to $13 before we look to buy it, but we only want to buy it for $11 or less, we'll set our stop price at $13 and our limit price at $11. So if the stock price rises up to the buy stop price of $13, then pulls back to the buy limit price of $11, then a buy stop limit order would be made at $11 or less. And when selling with a stop limit order, you set a sell stop price at which you want to start selling the stock. Then you would set a sell limit price below the sell stop price as the lowest price you would accept for the stock. For example, if you want to sell a stock at $8 and the least you would accept for that stock is $7, then you would set a sell stop price at $8 and a sell limit price at $7. That way, if the stock falls to $8 or below, it will be sold between $8 and $7. So those are the four major orders explained: market orders, limit orders, stop orders, and stop limit orders. If this video was helpful to you, please click the thumbs up button below. And for more educational content like this, don't forget to subscribe. You can also click the bell below to get notified when more contents are posted.